Hello, everyone. Good afternoon. I can see there is no one connected yet. So let's just wait a little bit more. Another sudden live for today. So, welcome back to everyone. Another live session for today. How is everyone doing? Hi, Dimitro. Welcome back. So we have an interesting news today, and let's try to make some good trades together based on the news. So today is not just another day. We are about to witness the release of one of the most important data points in the entire macroeconomic calendar. The US GDP growth rate for the new quarter 2025. As we can see, I have the calendar page open. So this news is a figure that can shift traditional markets and one that will also have direct implications for the crypto space. So just two days ago, Powell gave a highly significant interview. He stated further rate cuts remain plausible before the end of this year. So there is a move that could impact not only the traditional economy, but also the crypto market. So Powell also emphasized that in his view, the US market currently appears overpriced. And this brings us to an interesting reflection. On one hand, more liquidity prospects could fuel markets. But on the other, stretch valuations increase the risk of sudden correction. So let's start with the current picture. Hello, Kata. Hello, Namahar Abdi. Welcome, everyone. So here we have the big impactful news for today, the US GDP. The last quarter figure came in 3.3 growth, signal of continued US economy resilience, as we can see on this interesting chart. So the forecast for today point is another plus 3.3. However, we know well that these numbers are often subject to later revisions, frequently downwards, which means that today's figure might look stronger than reality. And as traders, we should always keep a healthy dose of doubt. Another crucial point I want to show you guys is crucial point not to forget. In 2025, the US dollar has lost about 10% on Forex, as we can track it, is around like 10.5% dropping. So this move has provided an artificial boost to US exports and support for Wall Street and a positive effect on the GDP calculation themselves. So in other words, part of the growth we are seeing are not organic, are not organic, but rather the reflection of a weaker dollar and finalized dynamics. So this is key for understanding the next moves in the market. And the immediate reaction to the GDP figure will be sharp across sensitive forex pairs, US bond yields, and of course, equity index and crypto. So expect volatility today, maybe some sudden spikes and trading opportunities. Let's take a look on our Bitcoin chart, what is doing currently right now. 5 minute chart. It keeps dropping since today. So now let's go to the part that many of you are waiting for. So how does this tie into the crypto market? The link is stronger than it seems. So Bitcoin is both edge and risk on assets. So in recent quarters, Bitcoin has we had both as a safe haven as a risk on assets. So depending on the dominant narrative. So if the GDP comes in strong, markets may price in a more restrictive Fed. So downside pressure on Bitcoin and Ethereum. If GDP disappoints, traders may anticipate earlier monetary easing and positive flows to crypto. So a weaker dollar also questions the stability of USD backed stable coins. So the more the dollar loses real purchasing power, the stronger the narrative will be of Bitcoin as digital hard money. So the strength of the US economy and Wall Street directly impacts inflows into Bitcoin and Ethereum and ETF as well, crypto ETF. So if the sentiment stays positive, steady flows are likely. If not, there is a risk of declines. But of course, that will happen just in a short period of time. So it's not a durable scenario. It's just for the upcoming news. So if we take a multi-year perspective, from a multi-year perspective, the US maintains an average growth rate between 2.5% and 3%. Values consistent with the post-COVID era 2020, as we can see from the chart. So the resilience is supported by a drop in imports, public spending adjustments, deficit reduction, partly thanks to trade tariff, all of which shape the overall sentiment of global markets, including, of course, digital assets as crypto. Bitcoin is going up on the strong supports. As we can see, guys, is retracing up a little bit. And today we also have at 2:30 p.m. another important news about the unemployment rate, the jobless claims. So 70 minutes left from the jobless claims data and from the GDP growth rate. So be ready to see some interesting move on Bitcoin. It is approaching the moving average, and I draw some pivot points. So the first target, next station from the level the primary level, the P, was the S1 that, as you can see, it has reached it. But the sentiment is still negative. So the next target is the level S2. So I don't think this support will resist that much. Maybe after the news, we can see some like ping pong here and then a big spike upward if the data is good news. Order block, as you can see, shows us big amount of sellers. Hello, Soda. Welcome back. Today is a full news day and live day. So after this, we're gonna have, as usual, our scalping session, me and Ben, using our fantastic tool, Quick Scan. But today is another important day if you are a day trader because there are some interesting news that are gonna be released soon. So we want to have some trading light together. Let's see what the market is doing on overall. Let's see some live on journalists from US.
Confusing stories, which is why they're so divided. They are divided over just where neutral is, how restrictive we actually are, how restrictive we should be, and to have that conversation openly, you need to agree on an endpoint, a start point. None of them agree on where neutral is, and I understand that, but ultimately that's the source of a lot of the debate, a lot of the division on the FOMC and the dot plot.
Yeah, and I don't have a lot of confidence in what exactly the reaction function is to either a weaker jobs print or potentially even a reacceleration in inflation. One thing that Mary Daly said is that recession risk is very low, talked about how she doesn't want to see a worsening in the labor market, but then Austin Goolsbee talking about inflation still remaining above target for so many years. At what point does that become a preeminent concern?
I will say that everyone was extremely friendly and welcoming and kind and collegial, and I really appreciated that. And you know, it's important to understand that the FOMC is a body, the Federal Open Market Committee is a body that makes decisions by arguing on the merits of the economics and the merits of policy. And that's how it was, and everyone was very collegial in hearing their views, and I the same, and that's how it'll continue to be. You know, we make policy, as the chairman said last week, by persuasion, and so I will continue to try to lay out my views and make the case as best as I can.
The governor essentially got the opportunity to articulate your argument. Just how much daylight did you sense was there was between you and everyone else on the committee?
Well, I mean, it's sort of funny. If you look at the dots in the summary of economic projections, obviously there's a divergence between my projection for appropriate policy for 2025 versus where the weight of everyone else's is. But if you look at next year and the year after, I'm sure I'm still on the low end, but there's not really that much daylight between all the rest of the dots and myself and following here. So it's really just about the speed with which we come down to what's closer to neutral.
Well, let's get into the neutral argument. I think that's what separates you from a lot of people. So you've got it in the mid twos, Governor, and you think we should get there quickly. Can you just build out why you believe that's the case and why we should get there so fast?
Sure. So, look, I discussed a number of forces which have kicked in over the course of this year and which are, I think, in stark contrast to where they were last year. So I've argued that neutral was higher in the past than it is now, and that neutral was higher for a variety of reasons, but I've highlighted recently fiscal policy, sort of driving up net national borrowing, decreasing net national savings, as well as immigration policy, driving what was the biggest positive population growth shock in my lifetime and has now turned into the biggest negative population growth shock in my lifetime in very rapid succession relative to how changes in population growth normally occur in the data. And so to me, when you have huge swings in net national savings driven by fiscal policy, then you have huge swings in population growth driven by changes to border policy, it would be bizarre for me to think that wouldn't have implications for the fundamental structure of the economy that gets reflected through monetary policy in the neutral rate. So my view is that neutral was higher last year because of these reasons. So last year policy was not as tight as a lot of people believe, and now neutral has come down or is in the process of coming down, and now policy is more tight than people believe. And this has happened recently. These policies didn't change, sort of overnight. They've been kicking in over the course of the year, and that means that policy is becoming tighter every day as these policies continue to kick in. And my view is not one of enormous economic pessimism. I don't think the economy is about to crater. I don't think the labor market's about to fall off a cliff. However, the neutral rate is drifting down. And as a result of that, it's incumbent upon policy to adjust in response. And the longer that policy stays excessively restrictive, the greater the risks to the downside for the economy. If policy stays excessively restrictive for too long, then you do get to a situation in which you have a meaningful increase in the unemployment rate and a failure of the employment mandate.
So, Governor, that's the tension, I think, in your view, that's worth exploring just a little bit more. On the one hand, you don't think the risks are breaking down, but you also think we are excessively tight at the moment and getting tighter. There are some people who would say, and we've had this conversation around the table this morning, if we were as tight as you're suggesting, why is the market within 1% of record highs? Why are credit spreads super tight? And why is this economy still doing okay?
Yeah, so that's a perfectly natural thing to ask. Sorry, and let me say two things. One, I don't think that all financial conditions are universally loose like that. In particular, if you look at the housing market, I think it's in quite a different state than sort of some financial markets and sort of security markets. So I don't think that that's necessarily a holistic look at the world of financial conditions in the economy. But even that aside, I think that people in financial markets tend to focus a lot on monetary policy because interest rates are sort of huge tradable instruments, right? But there's so much more that goes into determining economic growth and the state of the economy and inflation and employment than monetary policy. And I think that attributing all changes in financial assets to monetary policy can be a mistake. And in particular, that's what I tried to do in my speech. Was to draw out some of these effects from non-monetary policies that are affecting the economy and, of course, therefore also financial markets. And so, if you have changes in tax policy, right, like significant incentives for investing that lower the effective tax rate on capital, of course, that's going to get reflected into capital assets. If you have significant changes to the regulatory environment, where you're removing barriers to operations that companies can make more cheaply, which, by the way, is disinflationary and pushes at the appetite cap, then of course that's also going to be reflected in asset markets. So I think it's a mistake to conflate the state of financial conditions with monetary policy. They're connected, they're related, they affect each other, but they're not exactly the same thing. And in the speech, I go line by line through these different items. And the reason why monetary policy doesn't have to react to the hawkish side in response to these policy changes is because they push out the supply side of the economy at the same time they push out demand. And so if you're increasing supply and demand at the same time, there's no change to the output gap. And of course, it's monetary policy job at the end of the day to be balancing the output gap, to be balancing aggregate supply and aggregate demand in the economy so it doesn't overheat or underheat.
I think there are a lot of people, Governor Myron, who would agree with you that probably the neutral rate is quite a bit below where we are now. You said even the other Fed governors did seem to agree. 2% target for the Federal Reserve for 53 consecutive months for more than 4 years. If there is an upsurge in inflation, how long are you willing to look through that if you are cutting rates before you say, hold on a second, maybe we need to stop?
Yeah, so I would want to understand why there was an upsurge in inflation, what was driving it, and then sort of think about whether that shock is likely to be persistent or whether the shock is likely to be transitory. And it's the nature of the shock. It's not just is inflation higher for a certain number of months, it's why is it higher or why is it lower? And how long are those shocks likely to persist? And if you have a situation in which inflation is much higher because there's, sort of, let's say a very significant expansion in national borrowing that drives up demand, that could be driven by fiscal, it could be driven by something else, that might be the type of thing that you would expect to be more persistent in my mind. If you have the type of shock that's driven by basically one-off change to tax rates, right, whether that's a VAT tax or tariffs or anything else, that in my mind is not the type of shock that would lead you to think that inflation is going to be sticky for a long period of time. And in fact, there's most central banks around the world, all of them would sort of encounter this in a much more direct manner through changes in value-added taxes. And they always look through them. They always say, okay, look, the VAT went up or the VAT went down, and that's going to affect the inflation statistics for a period of time. But then we all know that this was basically a fiscally mandated price change, and monetary policy shouldn't respond necessarily to fiscally mandated price changes because that's not indicative of changes to the underlying supply-demand balance in the economy, which ultimately drives the type of persistent inflation that the central bank cares about.
Governor Myron, I'd love to get your thoughts a little bit more deeper on housing. It's something Matt Miskin and Neil Dutta have talked a lot on this program about. Going into next year, do you think the housing market will weigh on a deceleration of inflation? Is that part of your thesis on inflation coming down?
Yeah, I mean, it explicitly is. I mean, look, supply and demand dominates all things economically, right? And if you're increasing the demand for housing by dramatically increasing population growth without a material increase in the supply of housing at the same time, of course, you are going to get upward pressure on shelter inflation. And then vice versa, if you start decreasing population growth because of a change in border policies without destroying shelter supply, or shelter supply keeps expanding at a rate that it has been in previous years, then you get a relative change in shelter inflation once again. So it's simple, it's simple supply and demand. If we have a material downward population shock because we have negative net migration, that's a net increase in the supply of shelter. And I think that the study that I cited in the speech on Monday, where Albert says, found that an elasticity of one, basically that a 1% increase in the number of immigrant renters leads to a 1 percentage point change in the rents.
Right, but immigration is short term, yeah. Right? This is a short term story. Would you be willing to revise up neutral if immigration is not much of a drag?
Well, I mean, you know, I have good reason for expecting that the immigration story is going to persist at least for another 3.5 years. And I think quite likely potentially after that also. So I'm not convinced that immigration is really a short-term story.
Governor, just before you go, because I know you've got to run, have you got a taste for this? Is this a position you'd like to keep beyond the end of this year?
Look, you know, I love this country and I'm happy to serve this country in any way that I'm asked to do so. But personnel decisions are not decisions that I make.
Governor Myron, appreciate your time. Diplomatic end. Thank you, sir. Thank you very much. Governor Myron from the Federal Reserve. On the next views from the Fed and his argument, very much lower neutral rate.
Yeah, and the key issue here in terms of how much delay there is between him and the other Fed members is speed. And he's saying that recently he saw a real turn and you might as well get ahead of that, especially with a very different backdrop. Also really interesting what he said about some of the other inputs to asset pricing and how that doesn't necessarily have to do with Fed rates, kind of agreeing with some of our previous guests talking about how it's been a Fed independent equity market in particular. The question you ended on is the one I was thinking about the entire time. Is this going to be a Governor Myron just till January, or is he going to be someone that the Trump administration decides we're going to keep him in that spot? And I think this is becoming very political in Washington, obviously, because he's still keeping even that.
All right, guys, only 2 minutes left from the data get release, and I can spot a huge selling volume here. So maybe someone already knows some insider trading stuff that we don't know yet. Let's stay tuned because on around 2 minutes we could see some big move, some spike on Bitcoin. Let's see the reaction.
You're not firing either, and the question is, which direction do you go and how fast do you get there? The whole question with Stephen Myron versus the rest of the Open Market Committee is where is neutral, and he makes a big case for negative population growth because of the negative labor force growth because of immigration. And that should start to show up in the jobs numbers, but not necessarily in terms of layoffs. So the jobless claims numbers may not settle that debate.
Mike, how persuasive is his argument at the moment, and how well received is it based on the communication we've had subsequently?
Well, it hasn't been extremely well received because there are some holes in his story, and some of the research he's cited isn't necessarily considered the best research. But the real issue is he's talking about this negative net migration, but the labor force has not slowed, has not fallen. So the impact he's talking about hasn't happened yet, but the inflation impact is still happening. So that's what the rest of the Open Market Committee is.
Oh guys, such a huge increase on the GDP third quarter from the United States, 3.8. Data just get released now, and as you can see, Bitcoin is pumping up. So it touched almost perfectly the pivot level I draw here, you see, and now it is pumping up. So we could assist soon at the price on Bitcoin moving again inside the top level and maybe trying to reach this volumetric absorption here and the primary point level again. So big numbers from the GDP, and let's have a look also on the initial jobless claim. So we have moved from 230K data, the forecast, to 218. So yeah, we are in a good macroeconomic situation in US. So the Fed maybe could be for the next month could be more restricted to cut some rates at the end of the year. So GDP strong, and initial jobless claim is going down.
Revision, and second revision, the third issue, 3.3%, a significant revision from 3.3%. Personal consumption is the reason Americans spend more money, 2.5% from 1.6%. No real change in the GDP quarterly price index, is 2.1% for headline on the year over year, and 2.6% for core. Both of those a little bit higher, but that's not the number we're looking at. We'll look tomorrow for the latest monthly release.
Mike McKee, thank you, sir. I just want to sit on one data point. There are many here, but let's pick out one. 218 on jobless claims. 218. We're freaking out about the labour market. Big downshift in payrolls. I understand the concerns. I'm not dismissing them. You see it. It's real. But the fact that claims are coming at 218, it doesn't speak to any kind of weakness whatsoever.
And even continuing claims actually came in slightly. They didn't expand, so people are coming off that. Look, no one is saying that this labor market is falling into a ditch. The point is, you need to have a more robust labor market in order to get growth that can sustain a lot of the expectations currently in markets. Do we need things to be a little bit less frozen? And ultimately, that might be the argument, but no one is saying that this is a labor market that is falling off.
I wish Governor Murren was still with us. Pretty impressive data points there. The jobless claims at least. Yields are up at the front end by, let's call it 4 basis points on 2, it's 364. There's been a steady grind higher in bond yields ever since the Federal Reserve cut interest rates last Wednesday. The 10-year bond yield's higher by about 3 basis points. So approaching again 420, we're at 417. And in the equity market, we were softer going into this print. We're softer still coming out of it. We're down 0.4% on the S&P, down by 0.8 on the small caps. Joining us around the table, Nita Richardson of ADP. Nita, good morning.
Good morning.
That claims number, pretty impressive, eh?
It is. In fact, if I would have just parachuted in from like some other place in time and
GDP,
saw those
that's
numbers, I think you just read, I would be like, so what's the issue? What's the problem here? This is a perfect economy. But the thing is, I've actually not parachuted in. I've been here the whole time, and I've been looking at the data. And there are some cracks here that I want to uncover, because yes, it is a low hire, low fire. It's been well-established jobs market. It's a stasis that I've been talking about with you for the better part of the year. But if you look, that stasis is having an effect that is not uniform in the labor market when it comes to wages. And wages, as I've said before, are the bridge between the jobs market and inflation. Inflation, when I look at those Fed projections, we're 4 years above target and 2 years to get to target. So wages are going to play a big role. And what you're seeing is that for low wage earners, those are the ones who are keeping wages higher for longer. They are losing ground to high income workers. So even though we have this low hire labor market, wages are suffering for those who are most affected by inflation, low income earners.
So this raises a question about what that means on a bigger scale, whether this tends to be a leading indicator of lower income workers are not seeing the pay raises that can keep up with inflation, whether that kind of leads a broader downshift, or if this just continues to emphasize the K-shaped economy where you have the high income earners benefiting from their wages, benefiting from the market, and benefiting from a world that seems to be increasingly catering to them.
Exactly. So when you look at that GDP print, it was on the backs of the 2.5% consumer spending growth. And that growth we think of as being really tough. So when you look at the labor market, and I said this last week with you, that the labor market is supporting consumers, but it's not supporting them uniformly. So for high-income workers, we're seeing that their wage growth is actually keeping up from a year ago, whereas for low-income workers, it's decelerating fast. And so the disparity is rising, and that's going to show up in consumer spending trends. You're going to see this disconnect between high-income people and low-income people. And who are those low-income workers? Well, the majority of them are women. 60% of workers at the bottom.
All right, guys, huge buying volume on this candle. Look at this spike. And the moving average is going close to the current price. So I expect to see again the price enters in this order block that is the same as the top level, grab some liquidity here, and the target remains this static resistance for now. But if Wall Street open with strong momentum, we could see Bitcoin reach the primary level of the pivot points struck here. So um, stay tuned and keep your eyes open on the Wall Street session, because right now volumes are getting inside the market. Look at these impressive spikes. The order book is uh, quite quite checking. So it's a good moment for some scalping session.
Immigration policy administration is not short term. He thinks it's going to continue for the remainder of 3.5 years.
Well, let's hold there. There's a lot going on with demographics in the labor market. It's not just immigration policy. It's the fact that 10,000 Americans every day are turning 65 and older and leaving as well. So those shifts are being seen in the labor force participation rate. It's edging down. You have the sandwich generation being impacted in terms of the number of hours they can contribute if they're taking care of their parents and their children. So there's a lot going on demographically. What it ends up being is labor shortages. The shortages could tilt up wages in the sectors that are most needed to take care of an aging population. But what I read in that is inflation. And that's what you don't want to see. You don't want to see a wage cycle that leads to an inflation increase.
When it comes to the other part of the labor markets, of course, a lot of these grads coming to school unable to find jobs. How much is AI part of that story, even though there should be enough supply given what's happening in immigration and given this aging workforce?
AI is having an effect on early career. We've partnered with Stanford on research showing just that using ADP data, that if you are in an AI exposed field, a software developer, customer service.
Is that everything at this point? AI exposed almost?
No, there are some jobs, like plumber, HVAC. There's actually quite a few jobs that are not AI exposed, but those aren't the jobs that young people are, especially college graduates, sometimes are oriented towards. But if you're in the healthcare field, needed more than ever, and you can see the employment trends going up. So not in 2025, maybe in 2035, every job will be an AI exposed job, but not now.
Nida, it's good to see you. Always is. Thank you. Nida Risserman there of ADP following that better than expected jobless claims data, the right kind of downside surprise. Kevin Gordon of Charles Schwab writes in, the biggest 2-week drop in claims since October 2021.
Yeah, if people were looking for some sort of confirmation of ongoing weakness, well, congratulations, you didn't get it. You actually got quite the opposite, the sense that things aren't falling out of bed. And it just goes to the ultimate question that we've been asking so much on this program, which is, are we heading into a reacceleration? Are we already seeing it, especially ahead of some of the infusion of cash from the One Big Beautiful Bill, and with the likes of the airlines saying that actually they're seeing bookings pick up. So, I mean, it might be on the heels of the upper quintile of earners, but nonetheless, that is the personal spending. That is some of what you're seeing maybe in this data.
If you're long equities, that's what you're priced for into next year. Let's see if we get it. Long equities with a reacceleration plus the interest rate cuts. There will be questions about that. If we continue getting data like this in the labour market, 218 for jobless claims. Big downside surprise. The estimate was 233 in our survey. Push that through the bond market and you were getting higher bond yield to the front end of the curve, up by 5. 2's up to 365. 10's up by 4 to about 418. Let's get you an update on news worldwide with your Bloomberg brief. Here's Yahara Hana. Hey, Yahara.
Hi, John. Let's recap that latest economic data. We saw weekly jobless claims fall by 14,000 last week to 218,000. That's the lowest level since mid-July. Analysts surveyed by Bloomberg were looking for 225,000 to 242,000. And don't bet against the U.S. consumer. Personal spending for the second quarter was revised up to 2.5% from 1.6%. Meanwhile, Best Buy has been making job cuts, including reductions to its Geek Squad team. Changes come as the electronics retailer has been impacted by tariffs and struggled to reignite the level of growth it saw from pandemic-era buying of computers and other gear. Shares of the company are down.
All right, guys. The price looks like uh, it has got some interesting base here, and bulls are stepping in. So it could be in the next couple of minutes a bit boring as trade because it's forming a compression phase, as we can see between the two pivot point S1 and S2. But as soon as Wall Street open, I'm sure we can see some breakout, maybe break up or break down to the S3 level, but it's quite hard to see that. My forecast is more on a breakout to reach this area and maybe keep dropping a little bit if Wall Street doesn't want to put some buying volume on crypto and in this case Bitcoin. So hope your trading is doing well. And as you know, we are going live in another hour again with our fantastic tool QuickScan. Make some interesting scalping, trying to spot some opportunities, some huge moves. So thanks everyone for this live. US economy is still strong as we all see right now. The growth rate GDP it has been revised in the second quarter at 3.8% instead of 3.3, and also the jobless claim fall to 180K. So solid numbers from America. The economy is solid and strong. So risk assets like Bitcoin will see some moving up. We everyone we hope so. After the Black Monday we saw recently 3 days ago. So if we take a look on a daily view, Bitcoin has a lot of margin on the upside to recover. We are still in lateral phase. So see you in 1 hour again with N, and let's have some fun together. Thanks everyone for today and see you next.